Ladies and gentlemen, dear guests, welcome to the 9th Research Conference of the National Bank of the Republic of North Macedonia, co-organized by Reinventing Bretton Woods Committee.
Dear President Pendarovsky, dear ministers, dear governors, your excellencies, distinguished guests, we wish you a warm welcome at the 9th Research Conference of the National Bank of the Republic of North Macedonia, this year co-organized with Reinventing Bretton Woods Committee. The title of the conference, Resurgence of Inflation and the New Geopolitical Realities, Redesigning Macroeconomic Policies, reflects a complex global surrounding, posing challenges to central banks and other policymakers around the globe. Many of these issues are on the conference agenda, and they are going to be tackled through policy and research-based discussions. The interesting topics, the highly profiled and experienced speakers, as well as the success of previous research conferences, are promising an interesting and engaging event this year too. At the beginning of this introductory part, let us invite the Executive Director of the Reinventing Bretton Woods Committee, Mark Uzan, to deliver his opening remarks. Mr. Uzan, the floor is yours.
Good morning, everyone. Mr. President, dear governors, dear guests. This is, for me, a great pleasure to welcome all of you to the 9th Research Conference that we are hosting with the National Bank of the Republic of Macedonia, and also the privilege, to start and to open the conference. Between the pandemic, war, energy, and climate emergencies, upheaval of global geopolitical balance, and questioning of Western democracies, the world changed dramatically. As we look back at the recent evolution of the world economy, what is most striking is the rapid pace at which change is occurring. Indeed, today's global economic landscape presents a great deal of novel and uncharted territory. The world has moved gradually from a dominant narrative favoring an open, multilateral international order to one where geopolitical considerations are having an increased bearing on the economy. Indeed, this is the second conference we have been hosting this month, and it's always a great privilege now that we see President attending conference with central banks. The global stage is really in flux, with various international actors assuming new, often more confrontational role. Russia's war against Ukraine has challenged the foundation of multilateralism and the rule-based international order. China is moving into a new era, focusing on economic influence and diplomatic assertiveness, aiming at systemic change of the international order. So our conference today takes place at a challenging time, a time of weaker growth and widening divergence among regions and sectors on the economy. The fight against inflation has proven more difficult, meaning that higher prices will continue to wait, and tighter financial conditions will make the economic environment more challenging than it was before the pandemic. So one of the key topics for our panelists today will be to reflect on the reason why inflation is back since mid-2021. This will really clearly be part of our discussions to see if central banks were generally late in assessing the gravity of the inflation threat, particularly in the advanced economies. Are we now heading toward a new macroeconomic environment, higher rate for longer? What about the future of inflation? This is also a topic we will have to understand and to address. This will be the new challenge as it is likely that we'll have to reflect on structural change that are in the making and could result in cost push factors, whether one-off or perhaps extending over a long period of time. In the higher cost of operating global value chain, with the reshoring of some activities for security reasons, in the reshaping of global trade due to the lingering of geopolitical tensions, including the war in Europe, and in the fading of the disinflationary effect of China's role in reducing global manufacturing costs, and last but not least, in the additional cost for greening our economies. Are the traditional economic and monetary model well designed to capture the complexity of this new global environment to guide central bank policies? As President Christine Lagarde of the European Central Bank outlined in a recent speech at Jackson Hole, we are indeed witnessing many structural changes in labor supply, reshoring, a new geography for trade, geopolitical tensions, and greening the global economy that are going to be cost-augmenting factors. What are the other risks and financial that we should be reflecting in the short and medium term? There are indeed threats stemming at a global level from the stress of higher nominal and real interest rate, combined with the historical level of public and private debt outstanding, and of course, China growth slowdown with its concern over the debt sustainability of local government financial vehicles. How much spillover can we anticipate to the rest of the world? Will it be the main risk that the global economy will be facing in the medium term? And when we look at the long-term perspective, we cannot exclude now the grave geostrategic risk already mentioned, from additional war-driven shocks to food and fuel prices, and to the ongoing challenge of geopolitical fragmentation and climate change to preserve stability and prosperity for the longer term. And indeed, geopolitical factors are increasing surrounding decision-maker deliberation. Central banks around the world are called now to deal with the repercussion of strategic economic relations on macroeconomic variables, inflation dynamic, monetary policy, financial stability. This is a topic that we'll be looking in our second session today. And geopolitical induced shock of transitory nature may blur the picture for monetary policy by increasing uncertainty. More frequent geopolitical shock have the potential to increase output and inflation volatility, which may generate persistent dynamics that, even transitory, can pose a challenge to the conduct of monetary policy, its communication, and its transmission. For example, the shock of the Russian invasion of Ukraine has contributed to the buildup of the highest short-term inflation rate in decades. Central banks and governments have acted to address this shock and dampen the impact, and are likely to continue leading to be highly alert of social tensions going forwards. In this context, the openness that was until recently regarded as an uncontested strength of the EU could potentially turn, in a number of cases, into a source of vulnerability, amplifying this transmission of exogenous and geopolitical shocks. This is due to the large portion of the euro area economy reliant on a smooth functioning of the international exchange of goods, services, capital flow, and the substantial energy and technological dependence, among other issues. More frequent, larger geopolitical shocks are likely to affect different EU regions asymmetrically. In short, no country will emerge and will be unscathed with rising geoeconomic fragmentation. Last but not least, how this tendency will affect the Western Balkan countries in approaching the EU. This will be the third topic of our conference, and how to anchor this region permanently to the European family. So I hope that this conference comes at the right time to bring key experts from around the world to discuss the main challenge that the global economy is facing in the medium term, and what might be the right policies also to deepen regional collaborations. Thank you very much for joining us today, for participating to the conference. I want to thank the Governor of the Central Bank for accepting to cause this conference with us, but also all the staff of the Central Bank for making this conference a reality and working for the last few months to these logistics. Thank you very much again for your participation. Thank you.
Thank you, Mr. Uzan. Now, let us invite the Governor of the National Bank of the Republic of North Macedonia, Anita Angelovska-Bežoska, to deliver her opening speech. Governor, the floor is yours.
Honorable President Pendarovsky, dear governors and ministers, current and former, Mr. Uzan, Your Excellencies, representatives of academia and media, ladies and gentlemen. It's my great pleasure to welcome you at our traditional annual research conference, this time organized in cooperation with Reinventing Bretton Woods Committee. Recent series of shocks have been one of the greatest stress tests that our economic and financial systems, as well as our societies, has faced in the recent history. Therefore, the conference aims to shed some light on the short and medium-term macroeconomic implications. This also includes challenges in adequately calibrating or even redesigning the macroeconomic policies that might have to deal with permanently changing economic relationships, implying that we might be entering a new world rather than returning to the old one. The pandemic, energy shock, war in Ukraine have all yielded in an extremely complex and uncertain macroeconomic environment. We are faced with accelerating growth and probably long-term growth potential on the one hand, and surging inflation on the other, which, although is on a downward trajectory, is still projected to remain above the target in about 90% of the economies even next year. Concerning the forecast, however, given the size of the upward revisions of inflations, it seems that forecasting models are not well equipped to capture the changing realities and unprecedented level of uncertainty, although we are all aware, as the famous economist Galbraith said, economics is not an exact science. In fact, the greatest error in economics is in seeing the economy as a stable, immutable structure. Central banks' response to the swift transition from low to high inflationary environment was a swift transition from accommodative to a restrictive monetary policy. We have observed the most synchronized and the most aggressive global monetary policy tightening in the last 5 decades. No doubt, this tends to adversely affect the already slow post-pandemic recovery and expose some vulnerabilities in the financial systems. Still, we should not forget the key lessons from the 70s and 80s, that moving too slowly and too softly entails much more costly subsequent tightening and higher sacrifice ratio, which means higher foregone economic output to re-anchor inflationary expectations and bring down inflation. So, beyond the shadow of any doubt, stabilizing inflation is a priority. But what is the optimal policy mix to deal with it without significantly amplifying the already visible costs for the real economy and undermining financial stability? This, in particular, with a complex set of factors, including accelerated wage pressures, shape the inflationary developments. It appears that so far, global output loss has been large. Global GDP in the last 4 years was lower by 3.5 percentage points in comparison with the pre-pandemic forecast. And in emerging market economies, including the Western Balkans, the loss is even bigger. And that's not all, as medium-term forecasts point to a further slowing down of the growth dynamics, which is expected to remain well below the historical average of the 2 decades preceding the pandemics. Furthermore, these scenarios do not reflect the profound effects that the deglobalization and climate risks may have. While estimates of the cost of fragmentation vary, in some scenarios it can reduce the global real imports by 30%, with more pronounced effects in small, emerging economies, as they tend to be more dependent on external trade and finance and have a higher technological and knowledge gaps. These concerns are even more relevant for the Western Balkan economies, where globalization has acted as an engine of economic convergence, which, in fact, has doubled in the last 2 decades, but still remains low at about 40% of the EU income level. This clearly underlines the need for accelerated rather than decelerated global integration, underpinned by strengthened implementation of structural reforms. Now let me reflect in more details on the implications of this new rising interest rate environment on the financial systems. Swift monetary policy changes, although warranted, if not managed properly, can increase the risks on the financial stability segment. Historically, global interest rate hiking cycles often coincided with financial distress. Empirically speaking, a recent study indicates that 1 percentage point policy rate hike increases the probability of a financial crisis by 2 percentage points. In this current context, this risk is certainly relevant, as tightening is taking place after a protracted period of low interest rate, conducive to higher risk-taking in the bank, but even more so in the non-bank financial segment. In fact, recent banking stress in US and Switzerland is a powerful reminder that monetary tightening can have significant implications on the financial system, in particular if it is unexpected, rapid, follows a long period of accommodative monetary policy, and if combined with weaker risk management, prudential regulation, and supervisory oversight. This certainly raises the issue of possible trade-off between price and financial stability, the so-called financial dominance phenomenon, where financial stability concerns limit the monetary policy headroom. Avoiding financial dominance requires 2 important prerequisites. The first one is having a strong banking system balance sheet, well prepared to manage to the rise of interest rates. And the second prerequisite relates to the availability of effective financial stability instruments, both macroprudential instruments aimed at preventing the excessive risk-taking, but also resolution instruments designed to resolve banks in trouble without undermining the financial stability. On the capacity of the banking system in the CEC region to absorb possible losses, it seems that so far the risks are well contained. Banks have faced the recent multiple crisis contexts with strong capital and liquidity buffers that are broadly maintained and in some cases even increased. The latest data reveal a capital adequacy ratio of about 20%, while liquidity ratio close to 30%. Despite the weaker economic activity, the quality of the credit portfolio remains strong, with NPL ratio remaining below 4%, which is better off compared to the pre-pandemic levels. Still, there is no room for complacency, as transition to higher for longer interest rate environment could certainly expose some vulnerabilities in the financial system and test their resilience again down the road. Rising interest rates is a two-edged sword for the banks. On the one hand, it may help improve their earnings, as usually interest rate pass-through on deposits is weaker than on loans, and thus strengthen their capital positions. On the other hand, it increases the bank's exposure to the so-called hidden losses stemming from the long-term debt securities held till maturity, as was the case with the Silicon Valley Bank. In addition, interest rate risk may translate into credit risk, leading to accumulation of NPLs and lowering earnings. Whether the banks will be net beneficiaries in the short and even more importantly, in the medium term, will depend on the overall macro context. And the current macro context is complex, as interest rate hikes come at times of lost growth momentum and lingering inflationary pressures that are waning on the household and corporate income and their capacity for debt repayment. While households' debt in the region at about 28% of the GDP remains below some of the vulnerability thresholds, a deep dive into more granular data points to a vigilance as the share of vulnerable households has increased. Interest rate risk may be even more relevant for the companies, as they mostly borrow at a relatively short maturity with floating interest rates. IMF analysis shows that in emerging economies, the debt at risk has increased to 50% for the large firms and up to 70 to 80% for SMEs. It is clear that insolvency risk is heightened, which is visible through the rising trend in bankruptcy declarations, which in the region reached up to 20%. This may, in part, reflect normalization from the low levels which were hit during the pandemic, but also the fact that companies face difficulties to withstand the consequences of the triple shock: high energy, labor, and interest rate costs. This brings us to the second prerequisite to avoiding a financial dominance, which is having effective macroprudential and resolution tools. A BIS paper that looks into 157 monetary tightening episodes finds that macroprudential policy tightening, whether ahead or during a monetary tightening, helps to reduce the likelihood of financial stress, thus increasing the room for maneuver of the central banks in their fight against inflation. Did the regulators in the region follow this guidance? The answer is affirmative. We have witnessed continued enhancing of the macroprudential frameworks, including active use of countercyclical and systemic risk capital buffers, as well as borrower-based measures. Although prevention is the main objective of the macroprudential tools, we also have to be equipped with adequate resolution instruments in case risks materialize and threaten financial stability. Following the global financial crisis, one of the key areas of the regulatory reform was the resolution segment, with main objective of introducing bail-in instead of bail-out concept, that is using private money instead of public money dealing with the banks in problems. However, this presupposes that banks have such instruments in place or can provide them at capital markets, which seems challenging in economies with underdeveloped domestic markets. Tapping external financial markets is also a challenge, especially now when global financial markets have tightened, and even disproportionately more for the emerging economies, as visible through the rising interest rate spread. More broadly, the effectiveness of the resolution framework is influenced not only by its design, but also by the environment within which it operates, including the legal, judiciary system, and quality of institutions. Needless to say, the scores of emerging economies in these areas do need to significantly improve. To sum up, fight against inflation is a priority. But we should be mindful that the financial stability is also a precondition for financial stability. Despite the crisis episodes, financial systems have continued to significantly grow, especially in emerging economies, thus playing an increasingly important role for the income convergence. And given the new risks on the horizon, such as geoeconomic fragmentation and climate change, I believe their role will become even more vital. To avoid the risk of financial dominance or potential trade-off between price and financial stability in this environment of growing role, but also growing risks in the financial system, the key way forward is further strengthening their resilience. As writer Alain de Botton said, a good half of the art of living is building resilience. I believe this quote quite illustratively explains the central bank's past as well as future efforts that are crucial in this uncertain and shock-prone world. Thank you.
Thank you, Madam Governor. Ladies and gentlemen, dear guests, today we are honored by the presence of the President of the Republic of North Macedonia, Stevo Pendarovski, at the opening of the conference. President Pendarovski with his open speech.
Please, you should take your translation equipment. I'm going to speak in Macedonian. Poštovani prisutni, dame i gospoda, čest mi je da ve pozdravim na ova važna konferencija organizirana od Narodната банка на Република Северна Македонија и od Комитетот за преобразување на Бретон Вудс. Во 1958 година, пред 65 години, познатиот британски филозоф Исаија Берлин го одржа своето инаугуративно предавање на Оксфордскиот универзитет за двата концепта на слободата. Фокусирајќи се на тензијата меѓу слободата и еднаквоста, околу кои се водел и клучниот идеолошки конфликт во текот на студената војна, Берлин забележал дека поголема економска слобода може да води кон помала еднаквост и обратно. Од ова логично се наметнува прашањето каков треба да биде поредокот што ќе ја гарантира слободата без да ја дебалансира еднаквоста. Ова прашање е особено актуелно во кризни периоди, кога одново се соочуваме со дилемата како да обезбедиме економски раст, што би бил долгорочен, одржлив и еднакво достапен за што поширок круг на луѓе. Ова е и причината зашто една територијално мала држава како Северна Македонија посветува внимание на прашањето за глобалната финансиска архитектура во услови на геополитичка и геоекономска фрагментација. Ефектите од здравствената, енергетската, економската, социјалната и безбедносната криза конвергира во поликриза, која ги покачи цените на енергенсите и на прехранбените производи, го забави економскиот раст, ја забрза инфлацијата, ги зголеми животните трошоци и го стесни просторот за поддршка на економијата. Како мала, отворена и увозно зависна економија, ние диспропорционално ги чувствуваме ефектите од овие глобални потреси. И затоа нам ни е важно да биде пронајден модел за амортизирање на пазарните шокови во амбиент на постојано променливи економски околности. Во услови на нестабилно надворешно обкружување и се повисоки ценовни притисоци, особено поради војната во Украина, нашата Народна банка, по примерот на Европската централна банка, започна да ја прилагодува својата монетарна политика. При тоа факт е дека здравата монетарна политика придонесе да се зачува макроекономската стабилност на државата и делумно да се заузда растечката инфлација. Но тоа не значи дека сите предизвици се надминати. Геополитичките и геоекономските ризици неспорно ги засилуваат долгорочните негативни ефекти и врз демографијата. Имено неизвестноста го засилува масовното иселување на младите, не само од нашата земја, туку и од целиот región na zapadni od Balkán. A so toga gubíme neprocenljiv čovečki i socijalan kapital od kojeg zavisi dlogoročni od ekonomski rast i razvoj na našoj državi i na celiот region. За да го спречиме одливот на квалификувана работна сила, необходно е да се навратиме на дилемата на Исаија Берлин и да се обидеме да ги направиме нашите економски системи податливи и за развој на економската слобода и за еднаквоста на можностите. Необходни се реформи во виталните сегменти, клучни за економскиот развој како што се инвестициите, продуктивноста на трудот, димензионирање на образованието според барањата на пазарот на трудот и креирање на квалитетни работни места. Верувам дека тоа најдобро можеме да го постигнеме преку засилени реформи и забрзана интеграција во Европската Унија. Поголемата трговска и финансиска интеграција на регионот во европскиот пазар во изминативе децении беше еден од виталните фундаменти на економскиот раст. Во регионот на Западниот Балкан, токму македонската економија има највисоко ниво на трговска интеграција со Европската Унија. Меѓутоа, за македонските граѓани да ги почувствуваат придобивките од Унијата, освен трговска, неопходна е и политичка интеграција, што значи прифаќање и на европските стандарди и критериуми. Затоа нам и на земјите од регионот, повеќе од кога било порано, ни е неопходно на тамошно зајакнување, а не намалување на врските со развиените економии. Дозволете ми на крајот да го искажам моето уверување дека оваа конференција е можност да се даде стручно, автентично, меѓу останатото и регионално видување за овие прашања и дилеми. Затоа, освен пријатен престој во Скопје, ви посакувам успешна работа и презентирање на креативни концепти, идеи и предлози за надминување на посочените дилеми и предизвици. Благодарам.
Thank you, Mr. President, for your welcome speech. And now it is time for the first keynote lecture. We have the pleasure to follow the lecture of Alfred Kammer, Director of the European Department at the International Monetary Fund. Regretfully, due to his busy agenda, Mr. Kammer was not able to join us in Skopje, so we will now follow his lecture via a video feed.
Good afternoon, everybody. Thank you, Governor Bieżowska, for the invitation to speak. This conference could not be more timely as Europe simultaneously grapples with firmly bending the inflation curve in the near term and attempts to revive its growth engine in the medium term against the background of rising geopolitical risks. Europe has weathered well an unprecedented series of shocks, the pandemic and the energy crisis triggered by Russia's war in Ukraine. Severe downside scenarios were avoided. This is a big accomplishment. As the immediate economic effects of these shocks fade, a key policy priority for Europe is to focus on restoring price stability and securing strong and green growth. But achieving these goals is complicated by emerging headwinds. Geo-economic fragmentation and the impact of climate change pose new challenges that compound long-standing growth problems. Moreover, for countries in the Western Balkans, the convergence of income levels to those of advanced European economies has stalled for some time now, and the region is at risk of falling behind. But the future also offers opportunities. Think of the advance of electric vehicles, artificial intelligence, and nearshoring. To succeed, countries need to position themselves by implementing sound macroeconomic policies and undertaking reforms to strengthen productivity and improve the business environment. Let me first outline the current economic setting and the near-term outlook. We are projecting a soft landing, but both the domestic and external risks are tilted to the downside and the medium-term growth prospects are weak. Southern European countries this year generally fared better than average, in part reflecting the revival in the tourism sector during the summer. In contrast, Economies that are more dependent on manufacturing and other energy-intensive sectors, such as Germany and some Central, Eastern and Southeastern countries, have been hit hard. There are indications that activity in the third quarter has slowed further and that the downward momentum is spreading to services. The lagged effects of real income losses from high inflation and tighter macroeconomic policies will be shaping the outlook. There is little support expected from the global level. The effects of stronger growth in the US will largely be offset by the growth slowdown in China, although the magnitude of the impact could vary across countries. In short, the recovery from the double shock remains sluggish and the medium-term outlook remains clouded. The good news is that headline inflation has fallen in most of Europe and the Western Balkans. This largely reflects two factors: falling energy prices and the unwinding of supply chain bottlenecks. However, the recent spike in oil prices underscores the risks to the inflation trajectory. In addition, underlying core inflation rates have only begun to moderate and remain stubbornly high, often still 2 to 3 percentage points above policy targets. Labor markets remain tight overall, with some softening. Employment now stands above its pre-pandemic level in both advanced and emerging European economies. The tight labor market and high inflation have led to an acceleration in nominal wage growth across Europe, especially in Central, Eastern and Southeastern European countries. In the Western Balkans, rising nominal wage growth is contributing to already high inflation. Worryingly, growth of nominal wages in excess of productivity and inflation has started to drive up unit labor costs. This can lead to sustained wage price pass-through and risks decreasing the overall competitiveness of Western Balkan economies. Now let me move to the medium-term growth outlook. In the Western Balkans, the speed of convergence with advanced economies in output per capita has slowed over the last decade. In North Macedonia, for example, output per capita grew from around 27% of the EU average in 2000 to 37% in 2010, but then increased by only 1 percentage point to 38% by 2019. So what is driving this slowdown in convergence? In general, reforms have stalled and growth engines appear exhausted. A key factor is a still large investment gap in infrastructure and human capital. In North Macedonia, the capital output ratio has been declining despite steady productivity growth and increasing labor force participation. Other Western Balkan countries displayed a similar slowing of output per capita convergence, driven though more by a slowdown in productivity growth. Public infrastructure is substantially underdeveloped in the Western Balkans. As an example, North Macedonia has half the railway and motorway density of the EU average, half the installed power generation capacity, 30 to 40% lower phone lines, cellular and broadband subscriptions, and underinvestment in human capital and innovation. Another increasingly important factor is an insufficient labor supply. Young and educated workers continue to leave the Western Balkans for opportunities elsewhere. The latest census figures of 2021 indicate that at least 10% of the North Macedonian population has left the country over the last 2 decades. This type of migration has disproportionately negative effects on GDP per capita, as migrants tend to be more educated and younger. A recent IMF study showed that in the short run, a 1 percentage point increase in emigration leads to a 3% decrease in the number of firms with a similar effect on GDP. These domestic challenges are compounded by rising external risks. Here, global fragmentation continues to be a disruptive force and a driver of downside risks. The pandemic and Russia's war in Ukraine have disrupted commodity markets and global supply chains, raising concerns about national security and supply chain resilience. In response, many countries, even those that once championed free trade, are turning to inward-looking policies to isolate from rivals and secure strategic supplies of goods, from computer chips and semiconductors to rare earth minerals vital for clean technologies for the green transition. Trade restrictions have increased sharply by threefold last year compared to pre-pandemic levels. FDI is also increasingly concentrated among geopolitically aligned countries. We have also observed a surge of protectionist and discriminatory measures, such as local content requirements in industrial support programs and export restrictions targeting countries that are not regional trade partners. And policymakers are increasingly enacting measures to move production back home or to politically aligned countries. The global economic costs of fragmentation are not trivial. Estimates of the long-term output losses from restricting the international flow of goods and services, finance and technology range from 0.2 to 12% of global GDP, depending on the assumptions and scenarios. Over the long run, trade fragmentation alone, that is, the splintering of countries into blocs that trade exclusively with each other, could reduce annual global GDP by up to 7% or 7 trillion euros, which is the equivalent of the combined GDPs of France and Germany. Costs, of course, will vary by country. While some countries could benefit, reorientation of trade and supply chains may create localized growth opportunities. Most countries will lose. And these costs are just the trade fragmentation before we add the costs of climate change and weather events, which we have seen this summer from Canada, Hawaii, and Hong Kong to Greece and Libya. So, what can the countries in the region do to succeed in this new environment? The overarching near-term priority is to restore price stability. Decisively tackling inflation now will also help set the basis for stronger medium-term growth. Monetary policy needs to be kept in ambiguously tight territory until underlying inflationary pressures abate. Experience from past inflation episodes cautions against easing too early. Predictions of speedy disinflation can prove optimistic, as a new IMF paper shows. Easing too soon would be costly. Fighting inflation also needs the support of fiscal policy. Fiscal authorities should help fight inflation by containing current spending, not by cutting capital spending. There is a need to reinvigorate engines of growth that are at risk of being exhausted. Strengthening governance and improving the business environment will be key to boost investment, attract FDI, and keep high-skilled labor. Strengthening both institutions and macro fundamentals is critical, including for successfully implementing reforms. Weaker institutions make it easier for vested interests to block reform efforts, while sound economic policies complement and make reforms more palatable. Several central banks in the regions have come under strain from political interference. Central banks need to be able to fulfill their mandates on inflation. A stronger business climate is needed for domestic investors. To capitalize on FDI, policymakers should help create conditions that create an ecosystem of local suppliers, small and medium-sized enterprises to manufacture inputs for larger foreign companies. Here, strengthening governance via better anti-corruption frameworks and aligning regulations with international best practice would help. Investment is needed to facilitate the transition to renewable energy and green technology and to modernize transport and telecom infrastructure. Better infrastructure would help raise productivity and improve the attractiveness for foreign investment. This would support, in turn, capital accumulation and help close the gap with Western European economies. Finally, governments should decarbonize their energy sectors. Energy-intensive economic sectors will be increasingly uncompetitive with the EU's carbon border adjustment mechanism in place as soon as 2026. Policymakers should introduce carbon pricing and allow electricity prices to rise, using the resulting revenues to finance a transition to renewables. To conclude, if there is one key message to leave with you, it is that policies will matter. With the right policy mix, Western Balkan economies can secure low inflation and increase their long-term growth trajectory. At the macroeconomic level, this means keep a tight monetary stance and do not ease prematurely. And fiscal policy should help with this inflation. Structural policies also play an important role. Get the investment climate right. By strengthening governance via better anti-corruption frameworks, countries can durably attract investment domestically and from abroad. Success in the Western Balkans will require difficult reforms now that will pay off later. At the same time, the commitment to sound institutional framework needs to be maintained. This is an investment worth making and one that the IMF stands ready to support. Thank you.
Ladies and gentlemen, following these messages from the International Monetary Fund, we proceed with the first panel discussion for today. We now invite the moderator of the first panel and the panelists to take their seats on stage.
So it's a pleasure to be here at this most interesting and relevant conference. Thank you to Central Bank Governor Berezovska and the Central Bank colleagues for inviting me. Pleasure to be with this distinguished panel. Just a few short points. Obviously, this is well known, but I just wanted to frame it before we start with questions and opportunities for the panelists to talk a bit. I mean, you know the story. After decades of very subdued prices in the euro area, almost always below 2%, just about there in the US and other advanced economies, all of a sudden in April 2021, we had US inflation of 4.2%. And you know what happened afterwards. During the summer of 2021, both in Europe and in the US, inflation was picking up rapidly, while many economists, central bankers, policymakers were talking about inflation as a temporary or transitory event. The first hike in policy rates in the US came in March 2022. I mean, almost a full year before inflation pretty much doubled, tripled, quadrupled from policy targets. There was the first hike since 1981. Inflation by that time was, 12-month inflation was 8.5%. The ECB came even later in July 2022 when inflation was nearly 9% on a 12-month basis. Now, some developing countries moved much earlier. Poland hiked rates 3 times in 2021, Georgia, Republic of Georgia did so, Brazil, and so therefore there was this interesting dichotomy of how central bankers around the world looked at this surge in inflation, of course after COVID, after recovery of COVID. Now, there was a lot of surprise also among international organizations. I was looking at a recent study by the IMF that pointed out that the fund underestimated the impact of the fiscal interventions in advanced economies, very strong recovery after COVID. Of course, the shocks from Russia's invasion of Ukraine added to the fire after the 24th of February 2022. Now, I'm from the World Bank. We work on the developing countries of Europe and Central Asia. And 17 countries of our 23 clients have inflation targets. For 16 of them, inflation was well above target in 2022. Median increase of policy rates in 2022 among these countries was about 500 basis points and ranged dramatically from about 50 in Georgia to almost 1,200 basis points in Moldova. So now inflation has eased. Of course, global food and fuel prices have fallen, at least until June of this year. But still, central bankers clearly are not declaring a victory for slaying the inflation targets. In fact, the picking up of oil prices since June are slowing dramatically this inflation pace. In many countries, core inflation, as we've heard, remains stubbornly high, both across advanced and developing economies in Europe and Central Asia. And so all of this brings us to questions which I hope our panel would help address. That is, what have we learned? What is it that we can do in the future to be less surprised from events like this, when obviously the major policy decisions need to take place when inflation from low becomes very high, or vice versa? Are central banks moving too aggressively now with the risk of growth becoming much lower, low for longer, as interest rates remain high for longer? So with this, I'm going to stop my initial intervention. I'm going to ask a few questions, not necessarily in the order in which our panelists are sitting here. So first to Vice Governor Van Ackere from the National Bank of Belgium. How did you look at the 21 surge in inflation? Was it a surprise for you and your colleagues? What could be the policy mistakes that you could look at and say, this is what we have to avoid in the future? Thank you.
Well, for us to learn lessons, history has to repeat itself, because if history does not repeat itself, it's hard to learn lessons. And the President quoted a philosopher, so I'm going to endeavor also in quoting a philosopher. He was also an economist, but not a very good economist. I don't know if I can quote Marx here, but Marx said that history repeats itself. That's true, events happen again, but they happen first as a tragedy and then as a farce. So never does history resemble what happened in the previous periods, and that is one of the big issues. When we look at how inflation works and when we create our models, we do count on patterns to repeat themselves. But this time, if you have a look at what kind of a shock hit us, we have to recognize that this time it was the supply side first and foremost that took the direct hit from the shocks, whilst usually it's the demand side that drives the business cycle. This time it was supply constraints from COVID. It was the war, of course, that created the rising energy costs. It was some tightness in the labor markets that was unprecedented and not foreseen with all the Savant Phillips curves. It was something that was quite different than the previous occasions, combined, of course, with a surprisingly strong post-COVID rise in demand. And that had to do also with supportive policies coming from governments. And now so this time it was different for the economy. It was also different for policymakers due to the business cycle in which policymakers live, with at least in democracies where there are elections every 4 years or even sooner than that. They got accustomed to having policies that work foremost on affecting the demand and a little bit less on policies that affect supply, because to be able to do policies that affect supply, you have to have the confidence that you will stay in power not for 4 years but for 8 years, perhaps for 12 years, because these things take time. So this created an environment where not only for economy it was different, for policymakers it was different, also for the economists giving advice to the policymakers, it was different in the sense that their own forecasting models, counting on patterns, did not really give the results that happened in reality. This created an environment where I think that long-standing views on the respective roles of monetary policy and fiscal policies have somewhat been shaken. Traditionally, We expect monetary policy to steer demand, to make sure that it aligns well with supply. And in the ideal world, the fiscal policies, they try not to interfere too much, and they concentrate on the traditional duties of public finance, which is fairness, economic efficiency, and of course public debt sustainability. But COVID changed all that. COVID created an environment where people started to think that governments and fiscal policy could protect populations against any shock. And all in all, especially if I look to my country, purchasing power was very well protected, extremely well protected, of course at the cost of rising public debt. So, and to create even a bigger situation, all this happened in the context of a number of mega trends of which we do not have exactly established the effect. Deglobalization or fragmentation, aging of the population, migration issues, rising inequality, climate change, all these mega trends surely have an influence, but it is not yet possible to identify exactly how strong they will work. So I think the most important lesson, unfortunately, is this time it is different, and we'll have to learn to live with some uncertainty. And of course, to answer to your question, yes, we were surprised. And it was perfectly acceptable that fiscal did what they did when COVID hit. I think, honestly, there was no alternative. I think it was fair to say that monetary policy had to wait a little bit because a supply shock, you cannot resolve rising energy prices by raising interest rates. So it was logical that in a first degree, people and people in charge of monetary policy tended to wait a little bit to see if the spike was going to be temporary. It's only when you see that inflation is sticky that you have to start worrying, and that is of course what has happened after a couple of months.
Thank you so much, appreciate. Next question to you, Governor, Board Member Gerlach. Yeah, I mean, how do you look at inflation now? Are you worried that if it stays high for longer, even though interest rates are high for longer, it may become entrenched? These very high core inflation rates, the pickup in oil prices, in the context of very low growth around the world. How worried should you be about inflation becoming entrenched and therefore becoming much more difficult for monetary policy to tackle it in the future?
Okay, thank you. I think there is a clear risk of inflation becoming entrenched. We, at the Swiss National Bank, like to look at a heat map of the consumer price index, where we look at the different categories. You have energy in there, you have food in there, you have clothing and so on in there. And in the beginning of the inflation surge, obviously we had individual items that started flushing red, and the others were still normal. If we look at the map now, we have orange all over. We don't have flashing red anymore, but we have increases that are very broadly happening in the economy. And that is where monetary policy really has to come in and sort of take out this pressure. Now, what is very important, I mean, this broadening, that's second round effects already. You have higher energy prices that makes it more expensive to bake bread and so on. So you have this kind of, just through the different categories of the consumer basket, second round effects. But then there also is this wage price spiral. Now, when people think about what wage should I try to negotiate with my employer, that's partly backwards looking. How much purchasing power have I lost? But it's also very much forward-looking. What do I expect to lose next year and the year after? And there is where decisive monetary policy really comes in. It's really important that people believe that the inflation rate is going to come back to target, that there is this anchoring of the price dynamics, and that helps stop this wage price spiral. If one does not manage to stop this, if one does not manage to convey the determination of the central bank to stop this loss in purchasing power for consumers, then one really has this problem of entrenchment, and that one needs to be high with interest rates for a very long time. So that is why it's so important to react fast and really to convey the message: we are going to return inflation to where we promised it would be. If not, you have big problems and you need to stay high for very long.
May I follow up on this? What do you think of various calls, typically from economists, not from policymakers, to revise up inflation targets and use that as a way to tackle the inflation tiger?
Okay. Yeah, there were policy reviews of the Federal Reserve, the ECB. We in Switzerland did a little one as well. And these reviews were taken at a time when inflation was very low. Interest rates were very low, and the main argument for perhaps having a higher inflation target was if you move inflation expectations up, then the level of nominal interest rates is higher and you have more space to lower interest rates when that's necessary. So no quantitative easing, but you can just use your policy rate. Now, the reviews didn't change anything in the sort of, if you just look at the number, what should we aim for, there was no change. The Fed stuck with the number 2, the ECB stuck with the number 2. There were slight changes around this, but nothing major. So the level aimed for was not changed. We in Switzerland also didn't change anything. We want to have inflation between 0 and 2%. Now, that was the analysis, sort of the theory analysis, before inflation even started increasing. Now, nothing of these arguments has changed, and we're in a situation where inflation is high. If you now move up your inflation target, and that is a recipe for losing your credibility and for unanchoring inflation expectations. So I would be very hesitant to change anything now.
Thank you so much. Governor Vasle, next question for you. I mean, how do you see the current drivers of inflation? With much weaker growth, do you see things on the demand side pushing up prices? Do you see things largely on the supply side? I mean, obviously, we're talking about global fragmentation, geopolitical uncertainties. What do you look at when you think of inflation going forward? Thank you.
Thank you for your question, and allow me just to thank the organizers for inviting us here, being part of this panel and sharing some thoughts and intentions for our policy with you. Now, regarding the inflation and your question, there are encouraging signs regarding the future path of inflation, but there are also worrying signs in terms of what might go wrong in the next quarters. Now, the fact is that headline inflation is on a declining trend. We are much lower at the moment as compared to where we started this year. It's also true that core inflation declined a bit, but what we are seeing at the moment is more or less a stabilizing trend. Now, there are contributors to inflation which are slowly fading, and this will definitely support further disinflation process. Maybe the most important thing is moderation of growth. What we are seeing in this year is, after the rebound from 2 major crises in the past year, first COVID and then Russia aggression, that the growth is slowing down. We are still talking about positive numbers in many of basically all of the countries in the region, but the fact is that growth momentum will be much weaker during this year as compared to last year. On the other side, this is not paralleled with the developments in the labor market. Figures here are still very strong, very bold. From the historical perspective, for example, in my country, we are seeing record high employment numbers, record low unemployment numbers, and we are sharing these figures with many other countries in the region. So what is uncertain or unclear at the moment is how labor market will develop further, how this will affect wages, how this will affect demand, and consequently how this will affect inflation. Also, when we are talking about inflation dynamic, the fact is that we and the monetary policy side did significant steps in past quarters. Our campaign of increasing interest rate was really bold, really strong one. Again, in historical perspective, we did 450 bips. At the moment, our main interest rate is 4%, and this is providing a significant amount of restrictiveness to the economies. Now the question is how this changes, increases interest rates will be transmitted to the real economy. We are seeing a transmission to the banking sector at the moment, which is again very strong, also stronger if we compare it to previous inflation episodes. But what is not known or clear at the moment is how the second part of transmission will work, that is how the higher banking interest rate will be transferred to the real economy. So these are all questions which will determine not so much further path of interest rate, but the duration of restrictiveness we are providing at the moment.
Thank you very much. Could I just follow up? We heard from Deputy Governor Van Ackere that you can learn lessons when things repeat. What are the lessons for you from this episode of this surge in inflation? Is there something that you take for the future, how not to be surprised or how to respond in future surprises? What would be the lessons, and what was obviously the relevance of the geo-economic fragmentation that is going to be impacting your decisions in the future?
What we witnessed in past 3-4 years were really extraordinary developments. So, of course, there will be lessons for the future, but I really hope that we will not have to use them, because we are not expecting such an extraordinary development anymore. So under these circumstances, looking back with all the hindsight we are having now, I think we reacted in a proper way. Of course, there is always a question of timing, as was expected before, but as I said, it was not possible to anticipate first COVID, and then only 2 years after COVID, another crisis of such a great proportion. Namely, it was the first time since the Second World War that we witnessed such a major military conflict on our soil. So I believe that we used our tools appropriately, and of course what can be learned is the question which relates to the timing of our instruments.
Thank you very much. Governor Vujicic, a question for you, please. Governor Berezovska in her speech talked about the link between monetary policy and financial stability. Could you give us your perspective? How do you look at financial stability at present with very high policy rates but very low growth, commercial banks clearly under pressure? How would you look at that? How do we safeguard financial stability in these still extraordinary times?
Yeah. Thank you again for inviting us. Pleasure to be here again. On your question, I think that actually at the moment, if you look at the banking sector, they're doing very fine. It's time when the banks are making a very good profit, and this is a consequence of something which is unprecedented in terms of monetary policy making. The huge amount of the excess liquidity which was created over the last years, first after the Eurozone debt crisis, then particularly during the COVID, and the central bank buying a lot of the government debt and other assets. So what we had was that the central banks went down to the zero lower bound and then started to work with their balance sheet, and they did huge amount of the creation of the excess liquidity, something completely unprecedented. And on the way back, the way back is different. It's not that central banks shrunk their balance sheets and started to increase interest rates, but they started to increase interest rates, leaving the balance sheets being huge. And that creates an environment in which we have never been. Unique environment in which at the moment banks are profiting from that. Not only that their net interest margins are increasing, but they actually get a massive income on the risk-free assets that they keep with the central bank. They get 4% basically on the risk-free assets that they keep overnight with us. So far, so good for the banks. So the profitability goes up, return on equity goes up. It's very high now. You have 6 countries within the Eurozone in which the return on equity is over 20% at the moment. And although it will come down, it will stay in the double-digit area. So looking from that perspective, the financial stability looks quite good at the moment. Good times for the banks, but looking a little bit further out, maybe 3-4 years down the road, it might not look that well, but that then depends on the banks, on the jurisdictions in which the banks are based to a large extent. Those that have mostly fixed rates, as the funding costs will start to increase, and they are gradually increasing because most of the funding was coming actually from the overnight deposits, and these overnight deposits are now moving gradually towards the higher yielding strategies. As they move towards the high yielding strategies, the bank funding costs go up, and then if you have a long fixed rates and the policy rates stay high for longer, then at some point that starts to affect the economic value of the equity of the banks. So if you look at the markets, although the return on equity went up a lot, the price to book ratio did not move. It's pretty much flat. Which means that the markets don't fully believe, that the fairy tale story for the banks will continue for a very long period of time. On the other hand, the asset quality has not deteriorated significantly. We do have again a situation which is quite atypical compared to previous cycles. You had a very strong tightening, as Boshan said, unprecedentedly strong tightening of the financial conditions, with a slowdown in the economic activity, significant slowdown in the economic activity if you look over the last 2 years, but the value of the assets that banks keep has not really deteriorated. NPLs are very low, do not increase, and the stage 2 loans are moving up, but very, very, very gradually. And that is in a way also consistent with another atypical situation. So we have a atypical situation from many points of view, and that is that the labor market is very resilient. So this is also something that we usually have not seen in the previous episodes. The longer-term impact will depend to a large extent on whether we will be able to engineer a soft landing or we will have a hard landing. If it's a hard landing, then obviously it will affect a labor market, it will affect the quality of the assets of the banks in a much more profound way than we have seen so far. So that might endanger the financial stability. However, when you do the stress tests for the banks, the recent one, whatever bomb we throw on the banks, they still are doing fine. It's very difficult to properly stress them at the moment. So I would not be very much worried. However, again, it depends on, there is excess liquidity, but the European market is heterogeneous. So, Archimedes' law does not apply fully. It's not that, you put liquid and it goes to all the corners of the market at the same level. And those corners with less liquidity might be affected more. Banks which have lower reserves might at some point be faced with the deposit outflows in search for higher yielding opportunities, and we already see that the banks that saw deposit outflows have contracted lending more than those that have not seen the deposit outflows, that they have actually seen the deposit inflows. And also it depends on the structure of how much variable versus fixed loans they have. So we'll see. It's I think in the short term it looks very good for the banks. Longer term depends on many things, on hard lending versus soft lending, higher for longer, excess liquidity or not, and the structure of the assets in the balance sheet, particularly given the structure of the interest rates that they are faced. Even if those that hedge now, there are limited, I think, opportunities for hedging at this point for those that are in a position that maybe would require in normal times hedging.
Thank you very much. Thank you. Ms. Gerlach, could I come to you with a similar question? Because you sit, your colleagues, panelists sit on the European system of central banks there in the ECB. You sit on the board of a central bank that is absolutely crucial, besides the ECB and others, for global financial stability. How do you look at this issue between the link between monetary policy and financial stability? And I'm reminded of the times after the global financial crisis where some of the lessons people thought they learned from that crisis were that, well, we shouldn't only look at consumer price inflation, we should look at asset inflation, we should take much more proactive steps with macroprudential measures and so forth. Have these lessons from more than a decade ago been implemented, or were things so dramatically different that it was not possible? How do you look at things?
Okay, that's a lot of questions here. Okay, so let me start with the global financial crisis, right? We had this shock, we had this big banking crisis. We learned a lot of lessons. There have been large adjustments to the regulatory framework. So I think the world we're in today is much more resilient in terms of the banking sector than it was before the global financial crisis. So we've made a lot of progress. Obviously, there always can be shocks that put the banking sector into stress. And like you just said, if you look at the stress test today, we can throw a lot of bombs at the banking system, and they do fine as a whole in the stress tests. So sort of the known unknowns, we think we're better at handling. Now, obviously, you're talking also about Credit Suisse. You didn't mention it, but I mean that's the elephant in the room. And if you look at the Swiss banking system and how it has handled the increase in interest rates, it's handled that very well. We have this interest income which is going up. We have, in terms of the asset valuations, we've had a certain decrease there for the things that are marked to market. But the banking system all has handled well, and also for Credit Suisse, all these numbers have been fine. Credit Suisse had this problem of a confidence crisis, and that is due to a long series of risk decisions, bets they took that turned out bad. This goes back a couple of years. So the crisis we've had with Credit Suisse, I really don't think you can make the connection to the interest rate increase in Switzerland. Now, There is a certain link to monetary policy, and that is just sort of the uncertainty that was in the markets, and that then sort of the final spark for the Credit Suisse crisis really was the Silicon Valley Bank. And Silicon Valley Bank, that they got into trouble was that their assets, they lost a lot of value because of the interest rate increase in the US. So there is a certain link to monetary policy, but it's not sort of the increase in interest rates in Switzerland that had anything to do with Credit Suisse crisis. And I also have to say, if it hadn't been that spark, it might have well been another spark. So in general, I think the global financial system up to now is handling the increase in interest rates well, and I think that is to a large extent due to the improvements that have been made after the global financial crisis. Now, as there will be new shocks, it's hard to say what they will do, but as far as we've done our homework, as far as we've recognized this is what needs to be improved, I think these measures have been taken and they add a lot to the stability we see today.
Thank you so much. Deputy Governor Van Ackere, you talked earlier about fiscal policy when inflation started to pick up. Could you expand a little bit on the interactions between monetary and fiscal policy at present? How do you see the coordination or the lack of coordination? How do you see these linkages? Thank you.
Yeah, I honestly think that when looking for lessons, perhaps the interaction between fiscal and monetary is a domain where we should be able to learn a few things. And I'm sorry that as a central banker today, but I was in politics once in my life, so I still have solidarity for all these brave people who are in politics. I think especially when it comes to fiscal, some lessons have to be learned. I repeat that I think that the way of handling COVID was the right one. So massive support also for the populations, making sure that confidence was still there. But all in all, when we are looking at the rhythm with which monetary policy adapted to the new situation, and we can perhaps hear some criticisms that it took too long before monetary got into action, I honestly think that when it comes to rhythm or pace, fiscal has something to learn as well, because the normalization is a fact. There is no real COVID threat today. And we still have, for example, in the ECB, we still have the management of PEP and the acronym hides that we're still talking about pandemic measures, but I'm so sorry. Last time I looked, there was no pandemic anymore. And I agree that some of the things keep lingering on, but when it comes to fiscal, a lot is lingering on. Second point of perhaps criticism, always expressed with all the due respect, the best way to handle crises at the fiscal level is to be specific in your support, to not be general, to not hand money to people that do not really need the money to be able to continue their participation in the economic framework. That is not really what happened. And I'm talking about my own country, I'm talking about some European colleagues. All in all, the support was vastly general, and people that did not necessarily need the support got it. As a vice governor of the central bank, I got some support in my bills for the energy, and I didn't need it, and I got it anyway. So being more focused is something that should be learned. And as I already said in my first intervention, I think that politics, getting a little bit of time thanks to monetary policy, should focus a little bit more on structural reforms. Of course, there is a habit of saying we need to react because something is happening, we have to protect our people and protect their purchasing power, all very fine, but some measures when it comes to the supply side have not been put into place as soon as we should expect. I think when colleague Fazl talked about the labor market, one of the things, and especially in my country that is the case, that is very striking, is that the problem is not unemployment, the problem is inactivity. There's a disproportionate part of the population that is at the age of working and that does not participate in the process of, so of course you have low unemployment figures if a lot of people don't bother to present themselves to the labor market. But looking at the aging challenge, we need these people to be active. So installing new measures that create a little bit of more leeway on the supply side might also be a lesson to be learned when it comes to fiscal. And I apologize if you have the impression that as a central banker I'm talking about fiscal and about politics, but all in all I think that if you look at the coincidence between monetary and fiscal, we have had some happy times when both of us were pushing in the same direction. But today, unfortunately, we have a car where somebody is pushing the gas and the other is trying to push the brakes, and that is not the best way to go about it. I would prefer to have a little bit more of moderation, perhaps, both on the monetary side and on the fiscal side, but going into the same direction.
Thank you very much. Most relevant. Governor Vasile, could I ask you, how worried are you, or how worried should we be about low growth? Because for 2020, 2024, growth globally and in Europe is the lowest during any 5-year period over the last 33 years, since 1990. I mean, as a central bank, obviously this feeds into your policy decisions, but more generally, how should we think about very low growth, at least the one that's been projected, looking ahead?
Okay, to put current growth momentum in a slightly broader context, one important fact is that we had a very strong growth in 2022 and 2021 as well. There are also some revisions coming out at the moment, indicating that a rebound in parts of Europe was even stronger than previously anticipated. Now, what we are seeing in this year is moderation of growth, but as I mentioned earlier, we are still expecting positive growth in the euro area and some other important parts of the world. So we are not talking about recession, we are talking about lower growth, but still positive growth. What is also worth mentioning is that past experience, past 2-3 years, are that there were many soft indicators indicating weakening of the growth momentum, but at the end of the year what we actually received from the statistical offices as an official data was a better outcome as compared to the expectations. And this was in a way not surprising because as was already mentioned several times, past years were the period of extremely strong support to the economy, to the household, from the monetary policy side and also from the fiscal side. So, of course, we do have to take into consideration when we are deliberating on our monetary policy steps the fact that the growth is slowing down, but it's not the detrimental momentum for our policy action at the moment. We are expecting some help from the real side in terms of lowering inflation, but obviously it will not be enough, and further steps will be needed from our side, especially in terms of duration and QT programs to curb inflation.
Thank you so much. Governor Vujicic, you are the last country that has adopted the euro. Could you talk a little bit about how the experience has been so far, both in terms of the operationalization of the adoption of the euro, but also in terms of the impact on the economy, on inflation, on growth? Thank you.
Yeah. Yeah, we joined on the 1st of January of this year, and if you ask me the question last year this time, we were in the midst of the preparation, technical work, a lot of work that we had to do in order to properly prepare, and we thought, you know, we might have getting into the Eurozone some technical issues, problems. We talked with other countries, shared the experience. But it went very well, actually. It went flawlessly, very smoothly in technical terms, which is very important for the central bank, as we have been organizing most of the work around that. And in terms of the impact on the economy, it also went according to the expectations, and very much according to the experiences of the previous countries that joined the Eurozone. The inflation rate did go up because of the introduction of the euro, but we estimate that the impact was 0.4 percentage points, which is not a lot. We did that study immediately after we got into the Eurozone. We basically had estimates already in January, and then we did another round in March together with the ECB. And the impact was not very large, and particularly at the time when the inflation rate was high. You know, if the inflation rate was lower, probably that would be felt more. The important thing psychologically was that people do not confuse the high inflation with entry into the Eurozone. That was a clear risk, and we were afraid of that. Luckily, the peak of inflation was in November. Okay. So before the euro introduction. And since we got into the Eurozone, we had month by month, every month, inflation coming down, and that's good. It's not by the skill of the central bank, it's by luck. If it was the other way around, you know, everybody would have blamed the introduction of the euro on the inflation. It would be impossible to convince people it was not that. So we were also lucky. And then on the impact on the economy, we have exactly the same, again, experiences as other countries did. It's a credibility boost, risk premium comes down, interest rates come down, and now the problem is that happens at a time when you would like to see the more tightening of the financial conditions, and this is working the other way. And in particular, in our case, the problem was that we had to lower the reserve requirement at the time of the entry from 9% to 1%. And that was basically a loosening of the monetary policy stance just at the wrong time. So we have even more excess liquidity than the average of the Eurozone. I think that we are number 2 country in terms of the excess liquidity, you know, in the Eurozone, and that makes now the pass-through of the policy rate, DFR basically of the ECB, slower in Croatia than in most other jurisdictions, particularly on the deposit rates, because banks are just still flooded with liquidity, and the liquidity doesn't go anywhere, although some people have been telling me that you know, it will flow, that we're getting into the large, you know, market, Eurozone, connected, same banking market, same money market, so the money goes where it does not. It's still there, and that's, on one hand, it's good. You know, we're still growing 3% this year, when Eurozone is growing much slower. But in terms of the, you know, fight against the inflation, it's a bit of also an obstacle.
Could I add a brief comment for Boris? It is indeed as if he's already in the governing council since forever. And knowing that in this room there are a lot of people looking at some European ambitions of accession and things like that, in my former experience as a foreign minister, I know that one of the successes for Croatia to be in a position where after a few months it is as if the governor was always there, is that the preparation process. And I want to pay salute and tribute to the strong work that has been done in the years before coming into the Euro and being in the governing council. And I think Boris was instrumental also in that negotiation process. It is really about preparing well, and then once you get there, it is as if you're an old friend that has come home from a small trip.
You also said you were lucky, but I think precisely as Deputy Governor Vanacker said, when you're prepared, luck kind of works for you, right? Rather than against you.
Well, that's also true. Yeah, thank you.
So we've been very efficient with the questions and answers. I think central bankers, you really showed your mettle.
Different than politicians.
Would you like to have a few closing words, if you will? Governor Vanacker, would you like to end with a few words?
I think it was such a thrill to listen to my colleagues. No, I don't want to add something at this point in time. I think that one of the big lessons is that when it comes to economic and financial literacy, this whole episode has changed the way in which populations look at financial, economic, and even monetary realities. There was a time when the job of being a central banker was first and foremost very boring, and people did not really find that interesting. I think that today, and I'm talking for a country where 90% of the households have mortgages that are fixed rates, so they can really rest easy when it comes to hearing that that interest rates are being moved up. In Finland or in countries like Australia, that's completely the reverse. 90% have variable rates, and they feel the effect of a decision on interest rate hikes immediately in their own budget. I think that having a look at what the decisions that are being taken, what this means for individual households, and have an idea of the big heterogeneity of what happens, not only looking at it at a macro level, but knowing that there are differences between countries, is crucial to understand what is happening. We all live in a world where we count on the public acceptance or agreement with what happens to be able to have stable political systems, and that is something that is not necessarily a given. So I think the job of being a central banker has become a little bit more technical and is becoming a little bit more societal. Of course, most of the time central bankers, they hesitate to accept that challenge because they say that's something that politics has to do. But I feel that politics need a helping hand once in a while, be it by good advice or be it by sound monetary policies.
Thank you so much. Ms. Geller, would you like to?
Should I continue? Okay. I have 2 points I'd like to pick up on and sort of conclude on again. One is shocks, and the second is fiscal policy. Now, of course, the shocks we've seen, they've been incredibly unusual, sort of unknown unknowns which were hitting us, and in that way, history did not repeat itself at all. At the same time, certain mechanisms, how this is feeding through to the economy, how the economy is responding to monetary policy tightening, that's to a large extent compatible with the textbooks we had. So we're in sort of a mixture. We have these really large and totally unexpected shocks, yes, but certain things still work, and I think that gives us some comfort as well. Now, these shocks and how they feed through, that has brought a lot of uncertainty. We don't exactly know what their impact is going to be. This is something which sort of historians are going to be able to really take apart. And I think what is really important there is that one, as a central banker, tries to choose policies that are robust to different ways in which these shocks might turn out to affect the economy. So it's, I think, really important that we don't, with overconfidence, say it's going to be like that and the policy we choose is absolutely tailor-made for this one path of events taking place, but have a broader view and try to find policies that are compatible with different realizations and really of what is going to happen. So I think this robustness and not getting into a zigzag course, that's really important to keep our credibility and really keep the effectiveness of monetary policy high. So that's the one point. The other point, fiscal policy. I totally agree that it was absolutely necessary during the pandemic to support the economy with these fiscal measures. Now, there are two things one can debate about. One is just how much money was spent, and the other is how targeted the spending was. And in Switzerland, we have inflation back where we want it to be right now. We have 1.6% inflation. So we're back to normal, if you want. And we've looked a lot at different factors explaining that, and there's a number of them. I'm not going to go into all of them, but one of them is that if you look at the fiscal expansion we've had, that has been much lower than in other countries. And to some extent, that's sort of, we didn't need to do as much because Switzerland is a rich country and people had savings and so on. So I'm not criticizing the size in itself between different countries, but just the impact on inflation, that there's a link between how much fiscal expansion you do and what is going to happen to the economy and to inflation. And the other thing is just how targeted this is. I mean, what you just said, that you got fiscal support in the pandemic, obviously that's not necessary. And their sort of fiscal policy has the advantage of being able to target its policies much more than central banking has. Monetary policy has an interest rate, has perhaps an exchange rate, but those are very blunt instruments. And I think fiscal policy really there has the advantage to choose tailor-made measures. Thank you.
Wonderful, thank you. Governor Vujicic, you want to?
Well, as we've said a few times at this panel, we are in a situation which is quite atypical in many ways, and I would think that looking a little bit further down the road, we should hope that it stays atypical. Because if you look at the past experiences with inflation reduction, when it went up so quickly, so high, it's difficult to find an example where it worked without a recession. So usually it involves the recession. Hopefully this is also atypical in that sense that we are able to get the inflation back to target without causing the inflation. This is what we project now. This is official projection of the ECB and of all other major central banks. I'm quite confident that we will see now in next few months decline in the inflation rate, if for nothing else for the base effects, which are quite strong now in autumn. So maybe for probably get good news, but then the challenge will be in spring and next year to see whether the disinflation path is smooth and the inflation continues to go down as is projected and as the markets price it in, or it will stall at some point. And this is a risk of disinflation process in an environment of the soft landing and strong labor market with still a significant wage growth. Real incomes are now growing, so you might get into a situation where the inflation rate, disinflation process stops at the level which is not your target, and then it's challenging for the monetary policy because it has to do something more additional to bring it all the way back down to 2%. So this is how I see the immediate future, and that's where I think the risks are. hopefully we get a soft landing and a disinflation process, and everything goes down back to 2% without us having to do much more, but we have to be very careful, assess the risks, be vigilant. Near term, as we also said, financial stability risks are low, but then longer term, they might reappear. I think nobody should relax, particularly not bankers. They have done a very good job in the past years bringing down their costs. So the cost-to-income ratio in European banking went significantly down, not in Credit Suisse, but it went down a lot. And now with the revenue going up, it would be wrong to let the costs go up. Because then you might get yourself into a situation where 2 years down the road and the revenue starts to come down quickly, and the costs are much more difficult to be brought down. It usually takes, in this cycle, it took banks 6 years to really bring down the cost-to-income ratio. So these are all, I would say, risks. And then, of course, there are all these things that we don't know. The geopolitical risks, the impact on the energy prices, food prices, climate change. If you look at the futures today, they look good. Food prices coming down significantly. Futures for oil showing that, okay, it went up, but we expect it to come down. The problem is that very often they're wrong. So there are lots of uncertainties ahead of us, and we have to be very, very careful still.
Thank you very much. Governor Vasta?
I would also like to use this opportunity to warn against premature conclusions and even expectations regarding policy responses. Now, when I'm looking at you, at today's public, I see that I'm not alone who still very well remembers the past episode of high inflation in this region, and remembers very well as well how hard it was and how long-lasting the process of disinflation was. So yes, it's true that at the moment it seems that we are doing quite well. We are seeing some signs of inflation going down, also some first signs of sustainability of these trends. But on the other hand, there are still many uncertainties. Boris mentioned energy prices, food prices, including links to natural disasters. There is uncertainty on the labor market, how this will evolve, how the wage process will continue, and how will this affect inflation. There is also uncertainty regarding fiscal policy. Is there a realistic chance that fiscal policy will become more aligned with what we are doing? If not, the process of disinflation will be longer, more lengthy. So it's probably the case that we are done with interest rate increases, but now we are in the second phase, so-called duration phase, and I think that there are some expectations which are at the moment premature. I much more agree with what Alfred mentioned at the beginning, that we must be very careful with persistence of our measures in order to see more clear signs of inflation abating. Thank you.
So here you have it, dear audience. You heard from these distinguished board members, governors. I hope you enjoyed it as much as I did. We want to thank you, all of you, for this. Let's give our panelists. Thank you.
Dear guests, you're welcome to join the coffee break that is served in the lobby.